Welcome to the Institute for Neo-Economics Thinking Debt Talks series. This is the first of our installment. And my name is Moritz Schularick. I'm a fellow of INET, and I'll be hosting and moderating the event. Our first topic today is the rise of private debt in recent decades, the secular increase in debt. Global debt now stands at roughly $250 trillion globally. That's about 3 times global GDP. Since the global financial crisis that, in the eyes of many analysts, exposed the dangers of an over-leveraged financial system, debt has grown by another 60 trillion. And with the current crisis, debt will surge even further. And this has deep implications for the way our economies, societies, and politics work. And we want to explore the consequences. So in the Debt Talk series, we want to look at the causes and consequences of the rise of debt. We want to bring thinkers from different backgrounds together and different approaches. And we also want to look at the phenomenon of debt from different perspectives and disciplines. Today, as I mentioned, we want to kick off that series. We have the next series in September. We'll get back to this at the end, talking about debt and racial inequalities. Today, we want to talk about why debt has risen so much in recent decades. How can we explain that we live in such a high debt world, and what is the link to other big trends that we're seeing, such as rising inequality and financial globalization? To discuss this, we have a fantastic panel today. We have Professor Laura Carvalho, who joins us from Sao Paulo and is one of Brazil's most influential economic writers with a background in post-Keynesian economic thought. She will tell us more about that and her analysis in just a second. Our second panelist is Professor Amir Sufi, who is not your proverbial Chicago economist, although he is based at the University of Chicago at the Booth School of Business, to be correct. And he's also the author, jointly with Atif Mian, of the highly influential book House of Debt that came out a few years ago. And last but not least, we have Matt Klein, who is the economics commentator at Barron's and has written for the Financial Times and The Economist, among others. And he's the author of a recent book that has stirred up a lot of debate entitled Trade Wars Are Class Wars. Let's give you some information about the format, and then we'll kick it off. I'll ask every panelist for an introductory question, and then they'll give us their view of what's going on for about 3 to 5 minutes, and then we'll start a conversation between them and me. After about 40 minutes, I will start to channel questions of the audience, and throughout we will record this webinar, and you'll be able to rewatch it anytime. So with that quick introduction, I would like to ask the first question to Laura. Can you explain to us, can you run us through your thinking? Why do we live in a high debt world now? Why has debt, private debt in particular, increased so much in the past 3 to 4 decades? What is your analysis?
Thank you, Moritz. Thanks a lot for the invitation. Well, I'll start by focusing on household debt. I think there are, of course, different factors behind and also common factors behind the rise in debt. When we include public debt, there are drivers that may be singular. But my focus in research was always on the relationship between household debt and aggregate demand, household debt and income distribution. And I guess there we have a sense today of what happened. Arguments since the global financial crisis have focused on the link between inequality and household debt from 2 points of view, I would say. The first point of view, which is more conventional, is that there was a misguided attempt to redistribute from the financial system credit and efforts to encourage lending to poorer households who were left then with unsustainable debt levels, subprime mortgages, and so on. Right? Then there is a demand side view, I mean demand for credit, type of view, which is that lower income households were borrowing to sustain their living standards, given that income and wages were stagnant since the 1980s, and that in this way, inequality was driving the increase in debt. That can be found in the work of several economies. One of the first papers that pointed this out is the one by Barba and Pivetti, who basically created this hypothesis that credit was working as a replacement, as a substitute for wages in a way, as a driver of consumption. So inequality would be the cause of the rise in household debt. Then I guess we came to think that there is a problem with this view when we look at the data. And why do I say that? It doesn't mean that there is no link between inequality and the rise in debt. But the truth is that household debt is highly concentrated in the upper part of the distribution. So 60% of total household debt in the US is held by the richest 20% of households, which does not mean that we did indeed observe a higher debt to income ratio at the bottom of the distribution during this period. And then some people started to investigate that. There are several authors who looked into this. But the fact is that, as it seems, it is not that the increase in household debt to GDP for poor households was driven by an increase in consumption. What we see, and then there is an important work by another INET grantee, who is Arjun Jayadev, and also Josh Mason, who found that, in fact, the increase in household debt was more due to the famous Fisher equation that is usually used to see how public debt evolves, right? But the difference between interest rates and growth rates is more important to explain why household debt has grown relative to income for the poor households than a new borrowing or an irresponsible attempt to increase borrowing to boost consumption. So in fact, there, I think, when we look at that relationship, if I have to give one answer, the relationship between interest rates and growth and income growth rates is the crucial aspect for the rise in debt. And so that means that central banks have a role. And when we want to think of the future, central bank policy, of course, we have various interest rates, but central bank policy plays a crucial role. But then on the other side, income growth, of course, has to do with inequality, has to do with economic growth itself. And so, I mean, to give that first answer, I would stick to that relationship, right? Why interest rates were higher than growth rates, which is also the relationship that is crucial for Piketty's work on inequality, with all the criticism that has been attributed to that work. But there, I think we can then explore in detail why is that so, and what can happen in the future.
Great. Thank you so much, Laura. Let me move on to Amir. Amir, the question to you is, there's a lot of debt, but there are also a lot of assets on the other side. And you have done amazing work on trying to disentangle these debtor-creditor relationships in the economy. What is your take? Where is all the, why is debt risen so much? Where are all the assets and where are all the debts?
Thank you, Moritz. First, I want to thank Moritz and INET for inviting me here. And I just want to say, those of you who may be not familiar with INET, they're just doing fantastic work on this big picture question, which I think obviously is kind of what all of my scholarly work is focused on. So I'm a bit biased, but I think it is really, the rise in debt around the world is a first order consideration, something that this COVID crisis is only making more obvious. And so really want to commend INET and encourage people to check out their other webinars and their Twitter feed and their website. I just want to say before I answer your specific question, Moritz, that the deeper dive on pretty much everything I say today is based on research with Atif Mian and Ludwig Straub, 2 papers, The Saving Blood of the Rich and Indebted Demand, and both are available on our websites if you want the deeper dive into anything I say today. But yeah, I think Laura gave a great introduction to kind of this broader issue. I think at the end of the day that we have to think about 3 longer run secular trends when we're going to think about what's been going on with debt. And Laura mentioned 2 of them already. One is the rise in debt, obviously across almost all of the what I would call developed or advanced economies, as typically use this kind of language, which would be the US, the European Union, the UK, Japan, and Australia. We've seen a rise in debt in these countries since the 1980s. That's quite substantial, as Moritz had mentioned, on the order of doubling as a share of national income, sometimes even larger. That rise in debt has been concentrated primarily in household and government debt, which we think is a very important fact. Corporate debt, actually, or business debt, has been going up, but not nearly as aggressively as household and government debt. The other trend, which Laura mentioned, which I think is crucial for understanding or thinking about what's going on, is that interest rates have fallen. The real interest rates across all of these countries have fallen, and in fact are at their lowest level now, especially since the COVID crisis, than we've seen in kind of recent history, at least since the Great Depression. And so we basically have a situation in which we have extremely high debt levels, extremely low interest rates. And I would add a third factor that I think we need to consider onto the table, and that is, since the Great Recession, output has been pretty dismal across most advanced economies. And that's something that I think isn't widely appreciated. A lot of people look at the labor market, for example, in the United States, and they say, oh, it was really quite strong from 2015 to 2019. But if you look at output, it actually was way below the trend it was on before the Great Recession. And in fact, even trend growth had fallen if we compare pre-2008 to post-2008. So high debt levels, very low interest rates, low output growth is what we're basically facing. And I think a lot of us are focused on the COVID crisis. We wrote a book about the Great Recession, but it's important to remember that these are longer run structural issues that we kind of need to face when we're thinking about what's going on. Our recent research has really put in the simple observation which, as Laura mentioned, is kind of obvious, and it's kind of surprising more people don't use this assumption, which is that the rich tend to save more of their income than the non-rich. That's so intuitive and obvious that people may be surprised that it's not more widely considered, at least in the mainstream neoclassical economics. I know in post-Keynesian work, it's kind of taken as a given, but at least in neoclassical economics, this is not something that's widely used in models. Once we put that into a model, which is what we do in our indebted demand paper, you basically realize that a rise in income inequality leads to essentially more savings entering the financial system because, of course, the rich don't consume as much as the non-rich. And that can explain why interest rates will fall. Basically more credit supply coming into the financial sector looking for somewhere to go, and that's going to put downward pressure on interest rates, essentially trying to get someone to borrow. We would love if that money went into corporate investment or some productive uses, but it doesn't. Instead, it goes into household borrowing and government borrowing. And that game can only go on for so long until effectively you hit the lower bound on interest rates, which is where we've been since 2008. And once you hit the lower bound on interest rates, essentially then you get into massive hoarding problems. You can't generate demand through savings coming into the financial system. And so what do you see? You see lackluster output. You see asset prices start to explode. And you see a lot of the patterns that we've seen even before the COVID crisis. So we think income inequality is very important for understanding what's happened. Let me just finally respond to something that I think Laura mentioned, which I think is a very important point. We don't want to think of the rise in income inequality about the top 10 or top 20%. For us, the rise is about the top 1%. The top 1% itself is saving way more in the United States than it was, for example, in the 60s and 70s. And as Moritz's very nice work has shown, the top 1% have not been borrowing more. So Laura's exactly right that a lot of the borrowing is by people relatively high in the income distribution, but it's more, you should think of basically the 80th to the 99th percentile, in some sense, borrowing from the top 1%. And so when we're thinking about this factor as a factor that may be pushing down interest rates, pushing up debt levels, we want to think about the top 1% of the income or wealth distribution as being an important source of that. And so I've said enough for now, but I'm happy to dive in deeper as we go forward. But the bottom line for us is we do think the rise in income inequality, especially the rise in the top 1% income share, has been a very important factor in considering the rise in debt and the fall in interest rates.
Thank you so much, Amir. Matt, you start your book with a quote from Hobson, a theorist of the economics of imperialism around the turn of the 20th century. And the quote reads, The struggle for markets, the greater eagerness of producers to sell than of consumers to buy, is the crowning proof of a false economy of distribution. Imperialism is the fruit of this false economy. So this is some pretty strong ideas here that you put up about the distributional consequences and the international economic consequences of changes in the income distribution. Can you run us through your thoughts about how changes in distribution actually shape the global economy?
Sure, and again, thank you very much for having me here. And as Amir was crediting his co-authors, I have to give a lot of credit to Michael Pettis, who wrote the book with me, and I've learned a lot from him over the years and informed a lot of my thinking on these kinds of questions. Hobson's point essentially is an extension really of all those sort of secular factors that Amir was talking about, and essentially saying, what happens if you look at it in sort of a global system, and also how do you phrase it in a way that makes it sound a little punchier, I guess, which is that if you have a situation where people who, for a variety of reasons, are just going to spend much less of their income than everyone else on goods and services and spend much more on financial assets, and that group of people gets a much higher share, or progressively higher share of the total income distribution, total spending power, then you're going to have some kind of an imbalance within that society where you're going to have less and less consumption of goods and services and more desire to invest. The problem, though, is that within sort of a closed economy, the investment opportunities that you have are not going to be very attractive. Why would you invest in more productive capacity if all of the potential customers that you would have for that, that would absorb the extra output are not there? If your workers essentially are the consumers, and your workers are not getting paid anymore, then there's no point in producing more because they're not going to be able to buy any of your stuff. But of course, we don't live in a closed economy. I mean, globally we do, which is sort of a key point. Globally, I think it's really useful to think about this dynamic, and I think it explains why globally output growth has been weak. But country by country, of course, that's not how it works. And so a lot of these phenomena, both rising debt, rising inequality, slowing growth, the imbalances between productive capacity and demand, or not demand, people don't always demand things, but the actual spending and consumption of that productive output is very different across countries. And that can lead to very large flows, both financial flows and flows of goods and services, and imbalances. So when we talk about trade wars being class wars in the book, what that essentially is saying is that these large trade imbalances, these large financial imbalances, which often lead to crises, or if not crises, just large increases in debt that then become very difficult to service or slow down growth for the other reasons, those are necessarily tied to the global rise in inequality, and in particular, the rise in inequality within particular societies. So, for example, one of the situations that we spend a lot of time talking about is in Germany, which basically since reunification and since the sort of end of communism in Eastern Europe, for a variety of reasons, what happened was that workers, particularly in West Germany, this is not just an East German phenomenon, really in West Germany, had a long period of essentially stagnant to falling real wages, sharply increased unemployment, and businesses responded by slashing domestic investment, which makes sense. But Germany, by virtue of the fact that it's relatively small compared to the global economy, and also very integrated in terms of its companies with both the rest of Europe and the rest of the world, was able to make that work by essentially having companies, their revenues from exports were, essentially grew in line with the global economy, even as their costs from paying local workers and domestic investment fell. And that led to simultaneously a large increase in the profitability of German companies, and also the large increase in Germany's trade surplus. And those things had to go together. The rise in debt essentially occurred outside of Germany. So you had a situation where the rise in inequality and the rise in debt went together, just as Laura and Amir were talking about. It just happened to occur in a different country. And so from the perspective of someone looking at Germany by itself, you would say, oh, well, inequality does not lead to rising debt. But that's sort of, not really the right picture. That globally, you have to look at this together, and where the debt occurs versus not, that sort of depends on the particular institutions of that country and their openness to financial inflows from abroad and things like that, which is why, for example, the US, in many ways had a similar experience domestically as Germany, but a very different external position. And, we talk about that in the book, but essentially, all of these concepts we have about debt and inequality, they all fit together. And, the global dimension is essentially saying, well, globally it's a closed system, but individual countries are not. And so if you want to understand how the relationships of different individual sub economies interact with each other, you have to look at the way those flows go across borders.
Thank you very much. Does it matter for your argument, Matt, if I just ask the first question, that within Germany, the income distribution seems to be relatively stable and has not changed.
Well, I'm not sure, to be honest, on what specifically you're citing, at least in the period that we're looking at. So one of the measures we look at is essentially the net operating surplus of the German non-financial corporates as a share of net value add, and that it went from about sort of 25% to 37% in the span of about 10 years, and basically from the late 90s till 2008, which is massive. Another way of looking at this is that what De Status calls property income, the growth in that, or the sort of the operating, the net operating surplus of the German economy as a whole, the growth in that measure during the 2000s, which is when Germany went from essentially balanced trade to a massive trade surplus, accounted for something like 70% of the total growth in German national income, which is enormous. So in that sense, I think clearly German inequality did increase. And then there's some other data that you have. It's not necessarily as timely, but looking at sort of the share of income of, let's say, the top 1% or whatever. And I think the IMF actually published a study last year comparing that sort of, it was sort of a crude dual y-axis chart, but essentially saying that actually moved pretty well in line with the change in the current account surplus for that reason. So even though German inequality, especially after tax and transfers, might be a lot lower than, say, the United States, the direction of change was quite massive and coincident with, and I think connected to, the change in the trade balance.
So I think I understand your work and also what Matt has been saying implicitly as saying that we should think of credit booms and growth of debt also as savings booms. We should look at the other side. Where is all this money coming from? Well, the funds coming from that fuel the debt boom and fuel the credit boom. So what triggers that? What are the underlying factors that induce the sort of excess savings is it always linked to the income distribution? Can you think of other factors that cause it? What do we see these accelerations?
That's a great question. I think that, let me just preface the answer by saying, at the end of the day, the main price that we look at to try to decide whether this is more about a rise in credit demand versus a rise in credit supply is the interest rate. And a decline in the interest rate represents a situation as in a standard model in which you have an upward sloping saving supply curve and a downward sloping saving demand curve as a shift out in supply of credit, that there's more credit in the world that is looking for a return, which puts downward pressure on the interest rate. And so I think we always want to have the interest rate central in these discussions. That's also related to your question about the cycles as well. Most of these credit cycles has been shown over and over again. A lot of these credit booms that end badly are associated with declining interest rates during the credit boom. So that immediately tells you that it's more about a rise in the willingness to lend than it is about a rise in the eagerness to borrow. Now, what could cause those things? I think this is where the intersection of the work all three of us are doing comes, where we're pointing at income inequality in a kind of closed economy framework that we really think could be a big factor in pushing out the supply curve of credit available, right? The argument is, how many yachts really can Jeff Bezos buy, right? At some point, Jeff Bezos simply cannot consume nearly enough to keep his kind of wealth to income ratio at some constant. And so he basically puts way more money into the financial system. But then, of course, there's the classic idea that Ben Bernanke popularized of a global saving glut, which I think is what Matt's work in particular is focused on. Now, the source of the global saving glut, Matt and Michael argue, is also rising inequality in these countries, like Germany, like China. In their book, they make a very good case on that. You could also think in China of that being deliberate state policy. For example, a lot of people argued after the 1998 financial crisis, China wanted to stockpile a reserve of dollar-denominated assets. And so you do see, I think one thing that is remarkable, if you ever want to look at a remarkable pattern, look at how many agency mortgage-backed securities in the United States, that is ultimately mortgage debt by US households, was purchased by overseas investors from 1998 to 2006. It's just stunning. Before 1998, foreigners almost never directly bought mortgage-backed securities in the US. And starting in 1998, you see this just stunning rise in mortgages bought by foreigners. This is primarily Europeans, but also to some degree the Chinese. And that's something that you can point to concretely and say, look, it's almost impossible to imagine that it was something about demand from US households that led to that. It's very clear that there was this global savings glut that Ben Bernanke very nicely pointed out in 2005 that led to this influx of credit coming into the US. So that's what we mean by supply side factors.
So there is another tradition, and we'll come back to maybe the post-Keynesian analysis in a minute, but there's another tradition in financial economics to think about credit booms, debt buildups in the context of bubbles, right? If you think about Minsky, Kindleberger ideas where you have shifts in risk sentiment, behavioral finance factors that explain why all of a sudden the so many agents are willing to borrow and lend so much. How do we square those two approaches? How do we square inequality and changes in the supply of funds driven by the income distribution or international factors, and these, this substantial body of work from behavioral finance that talks about, sort of psychological factors, shifts in risk sentiment that are at the root of credit booms and debt increases? Open to anyone who wants to take the question, maybe.
Personally, I think they're completely consistent with each other insofar as, my understanding of sort of the Kindleberger model is that there's some sort of fundamental change in risk sentiment, usually based on, some kind of technological innovation or something like that. And then it's amplified over time through things such as changes in lending standards and even, cross-border financial flows. So I think it's entirely consistent. I think it's a question of the scope of these developments. So, for example, if you look at the context of some of the housing debt bubbles that we saw in Europe, for example, and during, before 2008, there were probably, at bottom, some kind of fundamental reason for why, you could say it would make sense. You have integration into the euro area, you have expectations of convergence, things like that. You had, in Spain, rapidly growing populations. But at the same time, would it have necessarily been as extreme to the extent that it was? And would it have been easy for people to have financed, the increase of that bubble without, the intercession of, essentially foreign lenders? And I think pretty clearly the data showed no, because the balance of payments data show that there was a lot of external borrowing to finance the domestic investments. So it presumably would have been lower. And I think, the US data show that as well for, our situation. So I think that, those things are not inconsistent with each other.
I did want to jump in actually, Moritz, and on a slightly different topic, because I think it is so important on this issue that Matthew and you were having about Germany and thinking about surplus of the corporate sector. And I think that raises an issue that's incredibly important, which is, especially since 2000, in a lot of the advanced countries of the world, the US in particular, a lot of the savings have been done by the corporate sector as opposed to the household sector. And that, in our view, at least, that's kind of a veil that you want to remove, actually. You don't want to think of the corporate, corporations aren't people, right? Corporations are owned by people. And so when you see the corporate sector saving more, you want to think about, well, really, who's saving more? And obviously in the US and in most countries, corporations are on the whole owned by pretty wealthy people. If you look at the shareholders of corporations, they tend to be quite rich. And so that corporate savings glut, which a lot of people have pointed to, really is in some sense a saving glut of the rich as well. And so that might lead to some reason why in Germany it might look like income inequality hasn't gone up if you just focus on the household sector. But once you include that corporate income in there, then in fact it's probably the case that income inequality has risen. And in fact, in the US, that's been an enormously important thing since 2000, that corporate savings have risen substantially. And I think that's an important part of the dynamic. A lot of that money ends up in household debt and government debt.
Okay, yeah, I would like to jump in actually on something Amir has said before, but I think it also has to do with your question, which is another perspective to look at what Amir is saying about higher savings driven by higher inequality is not on how it drives the supply of credit, but in any case on what it leads to, given that if you have high debt, And then you have a process by which inequality is increasing, and that generates higher savings. That, from a post-Keynesian demand side view of the world, contributes to stagnation. And high debt itself contributes to transfer income from those households who are paying interest on the debt to the rich households once again, right? And in a way, even if we may disagree on the exact causes on what has driven the rise in debt, still this reasoning shows us how stagnation this can become a trap in a way. So higher debt leads to higher inequality once again, which leads to higher savings, and then higher savings basically leads to underconsumption and stagnation in this fashion in a way, and that actually leads that to become unsustainable, even if borrowing is not increasing. And that was my point at the beginning. You don't need households to be willing to borrow more, and you don't even need the financial sector to be irresponsibly lending to have a situation in which that service is increasing relative to income if the world is not growing enough. And interest rates may be low, but still not be low enough for the ratio between that and income not to rise at the bottom of the distribution if we don't get out of this trap. So that's one of the aspects. But I agree there is no contradiction between that and the Minskian view, for instance, which is more of a cyclical story, right? I mean, you can have a trend in household debt and still have a cyclical boom and bust type of dynamics underneath it, right?
Yeah, Moritz, if you don't mind, can I just build on that? Because what Laura said is absolutely correct, and is actually, you know, this is an old idea, and it's incredibly powerful. It's exactly what we're trying to model in our indebted demand paper. In fact, that's the term, at least we have decided to call it, which is, you know, whatever led to the increase in debt, and we think it's inequality, but Laura's exactly right. It doesn't really matter what leads to it. Debt represents a transfer of future income flows from lower income people. And again, don't think lower 20%, think bottom 95% to the top 5%. And that future transfer of income, if you have higher saving rates of the rich, depress demand going forward and therefore lead to downward pressure on interest rates going forward. This is an incredibly crucial thing to think about. And I do want to make it incredibly relevant even for today, which is, I've been very intrigued by this debate, what we would call in the center left or left, about whether we have to worry about governments borrowing more, right? And I think this R less than G, which Laura has pointed out, has been very prominent in that discussion. But we just want to point out one thing, at least in our research, which is, don't forget that when the government borrows more, as long as they don't purely tax just the rich to pay the interest payments back, if they're going to tax the non-rich in any way, then that same indebted demand factors then lead to an argument that you might not want to just let government debt explode. And this is a very different argument than what you hear. Generally, people are like, oh, you don't want government debt to be too high because it's going to cause a crisis and interest rates are going to go up. That's not the argument from indebted demand at all. Instead, it is that more government debt ultimately represents a transfer of resources from the people who are going to be taxed to the people who own that debt. And the people who own that debt are disproportionately people very high up in the income and wealth distribution. So you have to consider that those future interest payments going to government debt will depress demand going forward and keep interest rates very depressed. Now, Laura's exactly right that if R is very low, then maybe you don't care. Maybe if the interest rate is so low, you don't care because you're like, oh, the payments are basically nothing. But it's at least an important factor that will kind of trap you at lower interest rates. You're never going to be able to have higher interest rates if the government borrows so much.
Yeah, very nice. It brings me to a question that I wanted to ask you as well. We've talked about the income distribution. If we look at the wealth distribution, it doesn't seem so clear that the borrowers, unless we should necessarily think of them as being poorer now, because a lot of that borrowing has occurred against inflated or high asset prices. To what extent does that enter the picture?
So at least in our research, one of the things we do in our Saving Blood of the Rich is we try very carefully, and Moritz, you've done this with your own research very well, is to very carefully try to think about whether households, say in the bottom 90%, have been saving more, or have they been just experiencing a rise in net worth that's coming purely from asset price inflation. And it turns out in Moritz's work, and we've confirmed it in our work, that it's all the latter, that pretty much any gains in the net worth of households in the bottom 90%, at least in the United States, have come exclusively from inflated asset prices and especially house prices. That is, especially before the Great Recession. Now, the danger in that, of course, is if asset prices collapse, as house prices did post-2008, households have not been saving anymore. In fact, they've been dissaving. The only reason their net worth appears to be high is because house prices have been going up. And so when the asset price falls, the households are effectively left with nothing, which is what's happened post-2008 in the US. Household net worth for households, especially in the bottom 60, 70% of the distribution, has just been incredibly low. And we think that's a persistent drag on demand. So this model of just relying on asset prices to be higher to generate consumption is a kind of dangerous thing to do, because of course, if those asset prices fall, there's no savings behind those asset prices. And therefore, you can see a big decline in demand, which I think is what we saw after the Great Recession.
Yeah, I have a point there too. I mean, yes, it is. I think mostly the rise in debt, in household debt in the US, was to finance assets rather than consumption. And I guess that relates to your point. If we look at consumption, the distribution of consumption, it really tracks the distribution of income very closely. And that point that was made several times at the beginning after the global financial crisis, that basically you had poor households consuming way beyond their means, and that's why that was rising. I think it really falls apart, at least for the US, when you look deeper into the data. And that, in a way, doesn't mean that the poor households are not the ones who are having a higher debt burden. Because you can have a situation in which households are not borrowing more to consume, but still their level of debt is increasing relative to their income, because their income is not growing at all. And in a way, that goes back to the first point I had made, which is the dynamics of that are not only due to the dynamics of credit, it's also related to how income is growing over time, and what interest rate is the one that is basically applied to that level of debt, right? And so even if assets are not, even for the households who are not having an asset price growth or a capital gains or anything like that, you could have higher debt just because the interest rate is not lower than the income growth of those households if income is not growing at all. And that's, I think, a major point there. Inequality is driving, it's creating a debt problem, even if it's not creating a consumption boom, a debt-led consumption boom, let's say.
So one thing I'd like to sort of, add on to this is that I think the story that Laura is saying is actually consistent with the idea of many people, at least in the United States, in the housing bubble, living beyond their means. And the way we can reconcile this is the fact that there was no consumption boom in the data. It's certainly correct. But what's interesting is that there was nevertheless an excess of consumption relative to actual income. And that really showed up in the trade balance. And so we can also, and it also showed up in the sort of monetization of asset price growth. And so obviously Amir and Atif have looked at this. And in fact, I picture people at the Fed, Alan Greenspan looked at this at the time, that the monetization of house price gains during the 2000s was very, very large. And you can think of it as, at its peak, it was something on the order of like 10% of personal income per year, basically between like sort of 2005, 2006. And, that was consistent with the fact that there was a large, even though consumption, average consumption per person relative to this trend was actually slightly below during this period of time, income growth relative to trend was much lower. And so, and that, manifested itself in trade deficit. In fact, there was a study not that long ago by economists at the New York Fed that basically said, well, it turns out that if you look at where the big housing debt increases occurred during this period, it's actually, you can line it up pretty well with the places that people like David Autor and so forth identified as the places that really lost out in terms of incomes and jobs from essentially import displacement, losing, and that, you know, there's a natural link there. So I think you can say that debt was compensating for income without saying there was a consumption boom, because essentially there was a hit to income that was, you know, exogenous, if you will. I think also the other way of looking at this is that there's you know, sometimes we're talking about this in a way that sounds like, you know, this, then this, then this. And I think it's also useful to think of it as sort of simultaneous processes, that income inequality could not increase without an increase in debt somewhere. And that the reason for this is that, you know, the income of the rich or businesses they control, which I agree with, I mean, we should just think of those as the same, that depends on the spending on goods and services by others. And globally, that means everyone who's not the rich and the companies. And if that spending is constrained because income has been flat or declining, then that means that, you know, the profits and and so forth of the people who own those businesses would not be increasing, and yet they are. And the reason is because you're having debt increase to finance that spending. So even though total spending might be weak or strong, you know, depending on which country you are, you know, those things, you know, there's sort of a symbiotic relationship there, that the income, you know, if you had a closed economy with no debt, then you wouldn't be able to increase corporate profitability in the aggregate by slashing wages, because you just have, you know, less revenues. But, you know, either in an open economy, you can sort of export that, and which is essentially sort of like the German model, or, you know, if we think about it in the global perspective, there just is a lot of debt that's showing up either on the household balance sheets or government balance sheets. And that's allowing spending to absorb some of this production. And that's, you know, going back to Hobson, I mean, that's essentially, you know, the reason why there was this sort of imperial dynamic, or Hobson's argument was, is that, you know, in places such as England and France and Germany, you had this massive, you know, excess of production relative to domestic spending, and you had to go abroad to essentially find people to absorb your products. And some of those transactions were sort of mutually beneficial if you look at sort of Australia, Canada, but other places it was not. And, you know, I think if you want to understand a lot of what's gone on in the global economy in the past few decades, you need to have that sort of understanding of the simultaneity of this process.
Let me just jump in, actually. You know, I'm thinking about just this conversation, and it's great. I think we're all in agreement about a lot of things, but it's a bit preaching to the choir. So let's take a step back, and just one of the things I've tried to do in my own research career is to take the great ideas that come from post-Keynesians, from Hobson, from Keynes, and try to use them to critique the neoclassical model. And so I think it's worth just to comment on why it is the neoclassical model misses these forces that I think Laura, Matt, Moritz, and I agree are kind of obvious. And I think one of the biggest flaws in the neoclassical economics model, which is used primarily within the traditional economics community, is this idea that savings equals investment, right? It's just this idea that, of course, if the rich save more, then it leads to capital formation. And it's so prominent in economic models that if you read like Romer's textbook, it's just taken for granted as if this is so obvious, savings equals investment. And I think one of the broader points we're trying to make, all four of us, I think, is that you shouldn't just take for granted that when someone saves $1, that's going to be transformed into capital formation. And so we always think savings is a good thing in the neoclassical model, right? Because more capital formation means higher growth and higher output and more happiness. But what's happening in the real world is, for whatever reason, and that our research is kind of silent on, I think Matt's taken a stronger stand on these demand side factors, but when the rich saves more, when China saves more, when Germany saves more, that money is not going into capital formation. It is going into borrowing by households and governments somewhere else. And so that's a big question about why that's happening. But I think the recognition that that is what's happening was what Hobson was on, 130 years ago. He understood this right away, but it's something that I think the mainstream economics community is still trying to get a handle on. How do you think about that? And it's closely linked to the idea of the representative agent and this notion that households are all the same, because you can't even appreciate this point until you think about the distribution. And so that's something crucial that we need to do.
Lara, if you want to react to this, go ahead. I wanted to throw in two questions from the audience that are, I think, very interesting for our debate. One is potentially about deglobalization and how we think that deglobalization, and I'll throw in I throw in the pandemic as well, will affect what we're seeing and what it also mean, what high debt also mean for the way we deal in terms of economic policy with the challenges ahead. Maybe Lara, if you want to, but you might have had something else. Please feel free to answer that first.
Yeah, sure. On the savings equal to investment, I do have as a Keynesian something to say, which is the fact that this identity works at the macroeconomic level doesn't mean that it has to work with the direction of causality that neoclassical economics takes it as granted. I agree. And in fact, higher savings in the Keynesian paradox of thrift idea leads, if individuals and also companies save more, that leads to lower aggregate demand, which then leads to lower output, which of course leads to, can even lead to lower savings at the aggregate level. And that's this distinction between what's happening at the individual micro level and what's happening at the macro level is really the point there. You can reconcile our macroeconomic identity with totally different behavioral stories, and I agree totally with Amir that there's nothing that leads leads savings to be interpreted as a good thing if we make that distinction. Then on the question you asked, Moritz, on the deglobalization, well, I mean, it's hard to tell whether this will be the consequence of the current pandemic. I guess there are different trends which are operating at the moment. One of them is, of course, even when we think about the circulation of people, right? The pandemic itself could lead to a world that is even more prone to tightening frontiers, and that can lead to the same process when we think about goods and of course trade wars that are even more fierce at the moment. But it is also the case that the world is facing a global problem, and there are also trends that go in the direction of strengthening global institutions. We will see a world with more debt. That's clear. And I think on our topic, that has consequences for financial flows and how countries will operate in the future. There is, in the case and bringing it to the reality of developing countries at the moment, a very big problem. It's not really the case in Brazil because we have a bit of a more comfortable position. We don't have any foreign debt, public debt. Pretty much we have way more international reserves than foreign public debt in Brazil. But if we look at other Latin American economies and African economies, the pandemic is going to leave us with a very high foreign debt, and again we will see the debtor countries paying, having a big social cost related to that in the future. And I think as we saw after the global financial crisis with the European periphery, we're gonna see a backlash of the pandemic crisis in a couple of years that has a big, I mean, that will be really related to the public debt and the foreign debt that we'll be left with. So there, I mean, we can have two approaches, right? A more solidary approach, which involves multilateral institutions renegotiating these debt levels, restructuring the debt levels by emerging markets, or we can have a new scenario where global inequalities will increase, which is one of the possibilities that we're facing right now, maybe the most likely one.
Matt, you've looked at China as well, and there were a couple of questions on state-led development models. What can we learn from China's experience with debt?
So there's a lot to learn. Actually, it sort of follows up with your question about deglobalization, because I think by certain measures, if you look at sort of cross-border financial positions relative to GDP or world trade relative to GDP, deglobalization has actually been going on for almost 10 years. And it's basically consistent with changes in well, on the financial positions, it has to do with the euro crisis largely and sort of unwinding of those bank positions. But on the trade side, it's because of China that a lot of the growth in globalization, sort of the aggregate level, was driven by South-South trade in sort of pre-2010. And then as China emerged from the global financial crisis, and it responded by essentially substituting for the collapse of its major export markets by massively ramping up domestic investment at the cost of its own domestic indebtedness. The government then responded starting sort of 2011, 2012 by trying to retrench. And so if you look at a simple chart, like Bank for International Settlements, for example, you can get the data very easily on Chinese non-financial debt, total debt relative to GDP. You see this massive increase between 2008 and 2011. And it continues to go up, but much more slowly. And that's a function of the fact that overall debt growth slowed down, fixed asset investment growth slowed down. And so I think in terms of the question of deglobalization and debt, we can actually sort of already have the answer, which is that there was deglobalization and that there was in fact, indebtedness basically did shrink in a certain sense. So a lot of, if you think about China's trade partners, their total debt to GDP, it stopped rising. China's total debt to GDP had risen a lot before, but then once it sort of shifts to retrenchment mode, you see that it rises much more slowly. So I think that we could very well see those things being linked, but it's not so much because of deglobalization per se, but so much as changes in China's own approach. In terms of the question of state-led development, I think this gets back to the question, what is this debt being used for? Why do we say that savings leading to investment is either useful or not useful way of thinking about this? And so, I think, getting back to what Amir is saying, sort of what is sort of the standard model, it's that you live in a world where there are a lot of really good investment opportunities. And because we're essentially, just on the edge of starvation, that, anything you can do to increase investment in those opportunities will lead to higher prosperity and better living standards and eventually more incomes for everyone, more consumption. That's sort of the standard model is based on this presumption. But, and if you're, a developing economy such as China, in say the 1990s, that actually is a reasonably good approximation of your environment. And so the Chinese government pursued a lot of policies to deliberately squeeze household consumption and transferring income to entities that would invest, whether it was local governments doing infrastructure or state-owned enterprises or state-affiliated enterprises. And that led to a very large increase in domestic investment, led to rapid upgrading of the country's infrastructure. And it generally did not lead to an increase in domestic indebtedness, in China, or for that matter, indebtedness with China's trade partners. You get to the 2000s and it's already sort of different, that there's still a lot of useful investment to be done in China, but much less relative to, what's essentially available, because the policies squeezing consumption have only sort of continued to increase in their magnitude. And so what happened then was essentially China's domestic indebtedness was flat. It did not increase relative to GDP. So it would look like, oh, domestic investment is still being relatively productive, but that's sort of a misleading picture because a lot of that investment was geared towards producing things for export elsewhere, and debt was rising outside of China. That was essentially the flip side of it. So, again, like you need to have sort of a global perspective to understand, how the debt and investment relationship works. Once those export markets became relatively less attractive because of, the financial crisis and just the inability of, for example, American households to keep borrowing against housing to finance consumption, the Chinese government essentially responded by saying, well, we're going to take this debt model inward. And you have a very large increase in debt there. But the underlying problem is the fact that the return on investment was quite low. That's the reason why domestic indebtedness rose so rapidly, is because you had this sort of not very productive investment going on. And before, the cost of that was essentially distributed to the rest of the world. So it wasn't obvious from looking at Chinese data. But then after 2008, it became a problem for China itself. And so, essentially this model that's derived from a situation where resources are very scarce, where you're basically living at the edge of subsistence. That's sort of the premise of why more savings leads to more investment, leads to higher income. That doesn't necessarily apply anymore if you don't have good investments opportunities available for a variety of reasons. And that, I think, is, China's illustrated that this problem. And, the development model sort of breaks down at different points in time for different societies, depending upon, a lot of specific circumstances for each country. But essentially, you can see that it can work well for a time, but then it stops. And in fact, you can see this with other countries having sort of similar developmental experiences. I think, it's not quite the same, but, Michael makes this point, I think it's convincing, that, you look at sort of Brazil's experiences for the 50s and 60s and or up until the early 70s, again, like you can generate a sort of a miracle economic growth for a while, but at a certain point, you sort of hit your limit based on, these other sort of fundamental constraints, and then it doesn't work out so well.
Yeah, great. Thank you so much. So we have so many excellent questions, and time is a scarce resource. So I want to give each of you a last opportunity, and it's a little bit the elephant in the room, and we haven't touched upon it, namely the question, what to do about it. We have fantastic questions here. One from Mo Ali about how do we think about options for redistribution, macroprudential policies. Kathleen Stevenson asks, what sets of policies would correct inequality and reduce debt? With a very early question from a gentleman, Toby Arbogast from the Bundesbank, saying like, oh, why don't we just make the rich consume more? Wouldn't that solve the problem as well? So I throw this out to you. What do you see, each of you, maybe in reverse order? What are the main implications that you draw? Are they redistributional, and if so, how? Are they about restructuring of the debt? So how do we go from where do we go from here? Maybe we start with Amir, and then Matthew, and then to Laura.
Yeah, well, thank you. These are all great questions. So in the indebted demand paper, we go through the policy implications quite in detail. And so let me try to just summarize in a minute what we think are the most important things. Now, I think the COVID crisis has amplified these concerns, but it's important to remember that the COVID crisis hit a world economy that was already structurally weak for many of the reasons we've already talked about. We tend to focus on income inequality as a primary force in generating this weakness. Very low interest rates, very high debt burdens, low output growth. Now, in our model, the kind of silver bullet that kind of hits all of the ways in which you try to fix this problem is to do some kind of productive government infrastructure project that generates higher wage growth, particularly for people in, say, the bottom 90% of the distribution. And you finance that infrastructure through something like progressive income taxation. It works on a lot of dimensions. If you think about infrastructure growth, if it's done well and it's done appropriately, not the kind of bad stuff that Matt's talking about that may have been being done in China, that can actually boost growth rates. That's great. It can also basically fix some of the income inequality issues if the returns to that infrastructure investment go primarily to people in the bottom 90%. If it's going to go to private equity firms and people in the top 1%, it's going to be far less useful because it's only going to aggravate the saving glut of the rich kind of problem. And finally, you want to finance it ultimately with progressive income taxation. Financing it with just more government debt, again, creates this transfer from people who pay taxes to the very top 1%, and that acts as kind of a drag on demand. And so all of this is to say, if you kind of look at it, if I look at what the table is, like some in the United States at least, which is the country I know best, some kind of massive green infrastructure type project seems like it would make a lot of sense for a lot of reasons. You get the environmental benefits and you also get the economic benefits. So I think that's the primary policy conclusion that comes out of our research.
That's amazing. Matt and Laura, we maybe a minute each. How do we solve the world's debt problem?
So I think, to zoom out, the debt problem is a consequence of the fact that there is this persistent, or has been a persistent excess of essentially productive capacity relative to spending that absorbs that productive capacity. And so, our view is that this mismatch essentially has come from the fact that you have way too much income and spending power concentrated among people who tend to save rather than consume. And so, if you think of it from that perspective, the solution is essentially, well, fix that. And there are a lot of ways to do this. I think, sort of to Amir's point, like you don't need to have something, really innovative relative to things we already know how to do. It's simply, conventional income redistribution from people at the very top to people lower down would be straightforward. You can have more government spending on productive investment. That would certainly work well in societies where investment has been politically constrained rather than economically constrained. So that would basically be, the US and Europe, for example. But those kinds of things would ultimately help, and you would generate more growth. You would generate less need for debt to absorb productive capacity, and everyone would be basically better off.
Well, I would tend to agree with the general direction of the policies that Matt and Amir have recommended. And in fact, we have to think that that is only a problem when we're not growing out of it, right? And when income is not growing enough. And for that, I'd like to to remember that Joseph Steindl, when he was talking about stagnation in his Maturity and Stagnation book in 1952, and then after the golden age of capitalism did not show the stagnation trends that he was expecting to see, in 79, he wrote something again on the difference between things that lead to stagnation as, say, natural forces and those that are related to policy. And he basically talked about stagnation policies as the ones that would be explaining stagnation in the 70s, and then later on he repeated that. And I would say that this is one of those moments. It's not that we have a natural tendency to stagnation in our economies. It's very possible to grow out of the current level of that if we have demand driven policies that stimulate not only demand as a whole in an aggregate level, but also I think redistribution of income is crucial for demand to grow in a sustainable way. And so, yes, the policies that, I mean, recovery plans and redistributive plans, and that requires, if we think of the world, fiscal solidarity to allow for that to happen would be the way to go out of this trap. Otherwise, we will be stuck with this situation, and central banks will also be stuck with this situation.
Fantastic. So it's my job to, and I do that. It's a great pleasure to have this 1 hour webinar with you. Thank you so much, Laura, Amir, Matthew, for being with us. Thank you to Claire Novak and Ed Haddad, who made that possible on the INET side. As I said, we look forward to the second debt talk in September about sort of debt and racial inequalities and how these topics interact. And the last but not least thing is INET's next webinar is going to be on Thursday, the AI Awakening Implications for the Economy with Eric Brynjolfsson on Thursday. So tune in. That's also going to be very interesting. Another big topic where we need new economic thinking. So from my side, thanks so much. I had a lot of fun and learned a lot. Thanks for joining us, and talk to you all soon. Bye-bye.